Hello, everyone. Today on the final bar, my guest is Chris Brecher from Brecher Trading, looking at a sort of short-term to shorter-term view on the S&P, but most importantly, looking at distribution we've seen this week relative to other rebalancing periods that we've had. It's actually a really interesting historical relationship you're going to want to see. Big distribution day, obviously, for stocks today, no matter which way you slice it, with energy really leading the way further down. Technology sort of sitting there in the midpoint in line with the overall equity market, but big distribution with almost 90% of stocks down today. So what does this mean for the long-term trend? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's show, The Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of these markets together. Today, it's all about the distribution, right? And I think in the context of what we've seen today, I think what I usually remind you in the introduction is to remember to stay focused on the long term. Don't get too caught up on the short term. Think about how this impacts the long-term trends. And I think that's an important thing to keep in mind on a day like today when it feels like everything's down, because essentially it for the most part very much is. But is this the end of the world? Certainly not. Is this potentially an indication of further weakness? Absolutely, could lean that way. And we'll look at some of the charts that might tell us a little more of a long-term story based on this. Things like weakening breadth, things like volume deterioration, which has been weak, but has really been more leaning on the downside than the upside. Also divergences that we're seeing. And I think things like the Qs, Microsoft, the big tech names, getting a lot of bearish divergences now that we've had today's sell-off, which sort of cements those lower peaks in momentum. Having said that, we have some fantastic guests. It's not just me that's hopefully going to help you update your process, upgrade your process and your thinking. Today, Chris Brecher joining us from Brecher Trading, has been on the show before. Does a really good job of just introducing the short-term environment and what it means. Tomorrow, we have Joe Duarte from Joe Duarte in the Money Options, author of a number of books, including Trading Options for Dummies. Next week on Behind the Charts on Monday, we interviewed Louis Navalier from Navalier Associates. He's a money manager, calls himself a fundamental quant, a mix of fundamental strategist and quantitative analyst, and includes momentum, includes earnings momentum, price momentum. So interesting to hear how a non-technician thinks about some of the concepts that you and I use day to day. Next week, two great guests, Jim Smith, who's a GAN strategist, joining us on the 30th on July 1st. Scott Smith, who's the technical analyst at briefing.com. Coming up in a couple of weeks, week of July 13th, charting the second half is our mid-year outlook week here on StockCharts TV. So special episodes of all our shows, special guests, a market outlook panel at the end of the week. You're not going to want to miss it. That's the week of July 13th, called Charting the Second Half. Let's get to our market recap. On days like this, I feel like our cup runneth over with things to look at and talk about. So I'll do my best to touch on some of the themes that I've uncovered just watching the markets, how they've evolved today. But again, by any stretch, it's certainly more distribution than anything. The S&P down over 2.5%, settling in around 30.50. So again, we haven't had a big down day like this in a couple of weeks. Right, a couple of weeks ago, Thursday, we had the big distribution day, very similar in how it feels to what we saw today. And again, what concerns me about a day like this is not just that we had one day, it's that this is now a pattern of a number of days that have been more distributed with heavy volume going downward. The small cap index, the mid cap index down even further. So small caps down 3.6%. The S&P 600 down below 800. The NASDAQ 100 now retesting that key 10,000 level, breaking above 10,000, sort of a pretty significant signal to potential further upside. Now we're right back at that now key level of psychological support, if you will. The VIX back up to just below 34. Looking at some other markets, the bond market continued to strengthen today. We talked yesterday about that trend line resistance and whether the TLT would be able to break above the trend line. Certainly leaning more that way today with the TLT getting above 163 and 10-year yields back below 70 basis points. On the commodity side, gold down about 1/3%, really came off into the lunchtime hour and then chopped around in a fairly tight range. Commodities overall down significantly, with the USO down the most, over 5%. The energy sector down 5.5%. So, the movement that we saw furthest to the downside today were from those groups that really recovered. There was that point a couple weeks ago where it felt like all those value-y groups were really starting to rebound. Things like energy, financials, industrials, airlines, right, defense stocks. It was like, oh man, these are all coming back. They're back down to earth. That happened yesterday. It's followed through today as well, with them down significantly. Financials, industrials, all down both over 3.5%. On the upside, utilities, staples, number one and number two, both down, but down the least. Interesting to see consumer discretionary, number three. Interesting to see technology, number five. So in the top half, you have some of those offensive sectors as well. And we've talked about the relative strength of technology for a while here. So even on a down day with the S&P down 2.6%, tech manages to be down just a little bit less, sort of continuing that relative outperformance. And again, I think, thinking of a place to hide in some sort of downturn, it's hard to disagree with something like technology, to be honest with you, with how it's held up. But so many divergences, which we'll try to look at here momentarily. Continuing our market recap, looking at a daily chart of the S&P 500. So, what we talked about yesterday, if you think about it, was 3150 being a very tactical line in the sand. We'd sort of established that over the last week and a half. This was, the big gap down Thursday. We then sort of traded back into that gap. 3150 about a week and a half ago. We retested that and retested it again yesterday. Notice, look, we traded right above that level and then closed back below. That's 3 times in a row we've traded above 3150 and closed lower on the day. That certainly feels like an area of resistance. We'd need to get above there to really give some sort of upside. Today's sell-off, while on its own did not take us down to 2,400 or something climactically bad, even though it felt certainly more negative than the average day we've seen recently, which is true. But it did take us out of this sort of short-term congestion range. Sort of puts us down in the lower end of this congestion area that we've been in. We talked about that range from around 3,029.50, which is this area of support here in orange, up to 3,200, 3,250. That was the resistance, the peak that we saw first week in June. We're now back in the lower half of that and really aiming more toward those previous lows. So today certainly felt weaker by a number of stretches. What I'd be looking for now is, are we able to remain above this support area? The last couple times we've pulled back, support has been right around 2970 or so, which coincidentally is right at the 50-day moving average. The 200-day moving average is at 3,020 or 3020. So we're able to hold some of this confluence of levels all around this range. So it would not be unrealistic to expect some sort of support here. If we break down below there, I would start to be looking at downside targets even further. We talked yesterday on RSI level of 50. We're just below that today, which means I think that's sort of in play. Are we able to hold this and rebound tomorrow, or is this the signal that the world is changing, that the markets are evolving more to a bearish tilt? Going to try to hit on just a couple different charts here as we continue. Thinking about breadth, we're going to talk a little bit about breadth in our segment later called Banking on Breadth. But I did want to point out this was an 88% down day. It looks like it's we're sort of shuffling the closing prices and getting all the data locked in. But it looked like almost a 90% down day for stocks. If you look at volume, I think it was a 90% down day volume wise, meaning that much volume on down closing stocks versus up closing stocks. But by whatever stretch, days that bearish phases tend to have a group of days where you have around 90% plus of stocks down on the day. If you look at that period from mid-February to late March, you can see all of that cluster of 90% down days, which I think sort of validates the downside momentum in a more of a bullish tape, especially coming out of the lows. You'll get this cluster of 90% up days as there's sort of a breadth thrust back to the upside. So interesting to see now we have almost the second distribution day, big distribution day in the last 2 weeks or so. Let's look elsewhere. What sort of themes we can unplug? All of the industry groups we tracked, just over 100 of them, all negative. The ones that were down the least are not surprising. I think if you think about traditional moves to defense, things like utilities, gold mining stocks, other utility groups. Half the groups down here are utilities and consumer staples, which sort of makes sense. Interesting though to see things like broadline retailers, toys in the top 10 list, when normally you think of that maybe more as traditional offense. On the downside, the industry is leading the way down the most. Recreational services, the worst group, down over 8%. Within energy, you have E&P stocks, oil equipment and services, all down significantly. But also some of these other groups that had been part of that reopening story, things like airlines down 7.5%. Gambling stocks over 6%, hotels down 5%. So this is certainly more of a move away from those groups that had started to recover or move back into more defensive positioning. And you can see that with small caps leading the way down, with the industry themes, with the sector themes, sort of all sort of validating that bit of rotation. We talked about airlines, and I just want to point out, I mean, this is when we looked at the chart of American Airlines, these sorts of names that have, established now lower peaks and lower lows. We talked about that yesterday, breaking below 14. And again, that's just, in general, that's not a type of chart that I'm going to be very excited about. Some people tend to, try to go more for value-oriented plays and buying on price weakness. I tend to look more for trends. And when I see stocks making new lows and lower highs, that certainly means more negative than positive. So I think with airlines, you certainly have to be cautious and watch the potential downside. Just to wrap up this comment, though, if there's one concerning thing, again, in terms of connecting the short term with the long term, there's a concerning number of divergences. If you look at big cap tech, communication services, here's Microsoft with higher highs in price. If you assume today's sell-off sort of establishes a lower peak there just below 205, you line that up to the second week in June, we have lower peaks in the RSI. If you look at Apple, similar sort of pattern here with higher highs in price, lower peaks in RSI. So these big mega cap leadership names all showing bearish divergences, which on their own is puts it on the list for me. The breakdown, the validation, the downside move is what sort of confirms that for me. But thinking of taking risk off of some of those sorts of names, I think would be totally justifiable based on some of these potential divergences here. That's our market recap for today. Again, there's so many places we could go. I try to touch on some of the themes that emerged in my work watching things evolve today. We'll take a quick commercial break. Back with my guest, Chris Brecher. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday for the show. As a reminder, we'd love to answer your questions in our Final Bar mailbag segment. We had a great segment yesterday answering some of your questions. We'll do it again at the end of the week. So shoot us an email, thefinalbar@StockCharts.com, or just hit us up on Twitter. Tag us in a comment at FinalBarSCTV. We'd love to look at your questions. We'll answer as many as we can on the air later this week. I want to welcome back to the show as my guest, Chris Brecher from Brecher Trading. Chris, welcome back.
Hi, thanks for having me on. Excited to be on because it was so slow today. I had more than enough time.
Well, it's always fun to come on a show and be interviewed on a day like this. So I appreciate your willingness to do so. But
oh yeah, sure.
It's obviously a lot of movement. I think there's been a lot of uncertainty, a lot of sort of treading water of sorts. And today we get this move to the downside. You sent some charts looking back to 2018, which is actually a really interesting way to think about this. Tell us what we're looking at here.
All right. There aren't a lot of just news items about rebalancing. But what happens is the reason I'm showing 2018 is there's three types of rebalancing. There's an S&P rebalance that's the third Friday of every quarter. There's a month-end rebalance by pension funds, and there's a quarterly rebalance. The one I'm showing you was the month-end, but the quarterly is coming up real time now this week. That's a gigantic sell imbalance. That's what's being reported, and that's what I figured out. And it all has to do with 50-50 funds and 60-40 funds. So the funds that are, let's say, half stocks, half bonds, as in January of 2018, when you go up that fast, all of a sudden these funds are, let's say, 65% stocks, 35% bonds. So they have to start unwinding and getting it back to 50-50. The thing in January, as you see, it was almost parabolic. So they had to unwind it in there, as you see. Now is the quarterly, and as you know, the market in the last quarter has gone bonkers, over 20% up. So these funds are way out of whack. The key, though, is the S&P rebalance, which is the third Friday of the month. It's already gone away. That's at the last minute. But the fund rebalance can be, they could jump the gun. So it hardly ever happens the last day of the month. That's what I think started happening today. Because really the virus news is the same as the virus news yesterday, but boy, did it act bad today. So what happened back then, and this is why I show these charts, is you can't just jump the gun on when the funds are going to sell. You have to see some kind of indication of reversal and indecision patterns. So as you see what you circled up there, that's the key. That was the indecision candle. Then the next day you got the dark cloud cover that took back half that indecision, the big candle up there. Right. So that was the first tip off that the rebalancing was starting. Then if you go to the next chart, you could see where to short it. So the key in there, and this is where like my subscribers, it drives them crazy. The better sale was actually 268, not 272. Because then the direction is known. So usually what I do is I see the break, you see the gap down right there. Then you see the oversold MACD, way down there. And that's where you wait for the consolidation and then you short the break, as you see in there. And that's the funds. You could tell then that it becomes a self-fulfilling prophecy. Everybody realizes, the funds are starting to sell. And that's how you dive. And then if you go to today, the same kind of thing, that yesterday the market went nuts. You had to wait for that reversal candle. And as you see, you got it yesterday, that big red candle that right at that resistance you mentioned in your program. So to me, sure, and you're right, you didn't know it was going to stop. Heck, it could go to 3,200 first yesterday morning. It looked that way. But that red candle was the tip off that this rebalancing was starting. And so I was trying to combine a theory with reversal candles because I might be dead wrong. So that's how I did it, of waiting for the turn. That's what I keep calling it. But definitely you see the indecision followed by the big red reversal candle.
What I love about the scenario you just described here, Chris, I think is fantastic, which is, something like the rebalancing, you sort of know it's coming, and when the market's been overheated, funds are going to have to rebalance a little bit, take some of the risk off out of equities and into bonds to get back in balance. But until you actually see the prices reflect that, you really don't know, when it's actually going to take place. So there's sort of the theory of what should happen, and then the price tells you what's actually happening, right? And that's the distribution we saw in the last 24 hours.
Exactly. I mean, you're seeing it dead right. In fact, if you didn't have the 2-hour up there and you had the daily, you would see, just like you posted, that the volume on the way up has been really low, but you've had people jump the gun for months saying, low volume, low volume. You needed to see that red candle or you don't know when it's going to stop. It's like a horror movie that, the bad person's coming out. You just don't know when. So you got to have some kind of trigger. So that's why
we only have about 30 seconds left, Chris, but I'd love to ask you, so assuming that this weakness and funds have to continue to rebalance, maybe there's a little bit of continued weakness, where do we go from here? You're indicating here a level just below 3,000. Is that where you would look for support? Or what would you be looking for?
I'd look for that panic low you saw at about 29.69, that little right in there, and then that candle, that reversal candle on the 15th of June 15th. That would be my area I'd look. And then we're going to look at individual stocks that have good patterns that are coming down to support.
Perfect. This is such a great lesson. And again, I think you're right, Chris. I think, a lot of people don't really understand what happens with rebalancing and how it can impact the markets like this. But this is a great history lesson on how it's actually played out and what we should be looking for here. Chris Brecher from Brecher Trading, thank you so much for coming back on the show. Pleasure to have you on.
Thanks for having me on.
That was Chris Brecher from Brecher Trading joining us. And again, I things like the rebalancing, there's if you're not familiar with it, you should look up it a little more. And it seems so counterintuitive that when the market is doing really well, funds have to rotate away from what's been doing so well. But that's the nature of keeping a proper 60-40 balance, or whatever it is that you're aiming for, is you have to keep, when things do really well, you have to actually pull back a little bit on your position to bring them back to that balance that you're looking for, that allocation. And so it can certainly impact when there's been a huge run and things have become dislocated a little bit. It certainly can cause some potential impact. And it's interesting to me, as Chris was talking, what I was thinking about is on the upside, you have this, my guest yesterday was Sam Burns was talking about the Fed stimulus and fiscal and monetary stimulus and how that's providing this sort of endless upside to stocks, or endless potential upside to stocks. Here we get a different structural reason why there's a sort of artificial distribution. It's not a potential bet on the direction. It's not speculation, but it's more just money management. So it's interesting that those are the forces we're trapped between right about now. Let's get to our next segment, which is called banking on breadth. So as we've talked about, looking at the broad indexes are very important. If you're going to look at one thing, I think what we've done so far really is the way to do it. But I think you have the benefit with charts, with technical analysis, to look a little further. And I think one of the best things you can do is start to look at breadth indications. So what we love to do in a segment called Banking on Breadth is really focus on the breadth characteristics and how they've evolved and what can it tell us about the current market conditions and what we might want to expect, or what we may expect going forward. First chart we'll look at, we've actually talked about a couple of these recently because they've been in play, meaning they've had some significant signals to pay attention to. This is the S&P 500, and then it's the percent of stocks on the New York Stock Exchange, and then on the S&P 500 that are above their 200-day moving average. What's interesting on the bottom panel is that still less than 50% of the S&P above their 200-day. This is not updated for today's close yet, but I would not be surprised if this moves even further down as some stocks have broken down that key support level. But it's interesting to note that even less stocks on the New York Stock Exchange are above their 200-day. It's only 30%, less than 30%. So what that shows you, it's another indication of the strength of sort of that mega cap, large cap led market, where small caps have been weaker, mid caps have been weaker. And as you incorporate those types of stocks in here in essentially an equal weighted measure, the numbers look less rosy when you incorporate those mid caps and lower cap range. This is zoomed in a little bit and just looking at the S&P 500. And again, if I'm to be bullish on this market, I'd want to see this indicator go above 50% and remain up there, because that's what bull cycles tend to look like. We had a bit of a head fake that lined up with this island reversal that we had a couple weeks ago. We then broke down, created this gap down. That gap has provided resistance. We've now gone even lower, and the percent of stocks has gone back below 50%. As long as it remains above there, it's hard to think that the average stock is doing very well. You have to assume that things are a little more on the struggle bus. Looking at the percent of stocks above their 50-day, we can see how this has rotated certainly lower, making a pattern of lower highs, lower lows, suggesting that stocks breaking below their 50-day as well. This chart we mentioned earlier in our market recap, I think it's just worth noting. This is a pretty big distribution day. It wasn't just a couple big stocks selling off. This was a wide distribution with the average, with most stocks, 9 out of 10 going down on the day. You know, new lows and new highs has been relatively anemic recently, only because so many stocks are within this range, just like the S&P 500. The 52-week range is pretty wide, with the S&P going from 3,400 to 2,200. So not surprisingly, not a ton of new highs and new lows. But we have had a sequence of new highs. On an average day, it's been 20, 25 stocks on the S&P 500 making a new 52-week high. That number is going to be pretty minimal today, and has certainly dried up a little bit. Again, bull markets are made when more and more stocks are making 52-week highs, driving the market higher. We're not seeing that necessarily. It's a relatively narrow group of stocks that are all pulling back today for sure. This chart, I haven't updated the colors for it, so sorry, I would want this to be sort of an amber neutral color. This is looking at the cumulative advanced decline lines for the major cap tiers, for the S&P, the mid cap index, the small cap index, and then the New York Stock Exchange here, number 2. And what I like to look at is just this overall trend. What are we seeing? Higher highs, lower lows, or a mix of them? And here we're actually seeing consolidation across the board. Lower peaks, higher valleys, or lower highs, higher lows, all 4 of these in a consolidation mode, which is not bullish, it's not bearish. At this point, I think it's sort of wait and see mode. I would be looking at as stocks sell off today, if that continues through the end of the week, I would be looking for breaks below those swing lows. That would, for me, would validate more potential downside, increased risk of going down through the 200-day moving average, if not even lower. The volume picture, as Chris mentioned, has been relatively light. We had a spike here yesterday, but overall it's been lighter over the course of the last couple weeks. This is the on balance volume, though, which again, not updated for today quite yet, but overall has been constructive. It's not broken to new highs. And what you look for here is what is the price doing relative to this on-balance volume? I think a breakdown in price, a breakdown of on-balance volume would confirm, more distribution on the downside. A little later, we're going to look at down volume here in a little different way. I think you'll see that the indication's a little more negative there. I actually mentioned the McClellan oscillator. This might have been one of the 3-on-3. It's a bit of a blur with how things change so much today. But, in general, when the McClellan oscillator is above zero, that's more bullish. When it's below zero, it's more bearish. This is a smoothed out version of the advanced decline lines. And it's an interesting one that I followed for a number of years. We've sort of chopped around that zero level, which is about what the market has felt like. But for a big stretch of April and May, it remained above zero. We're now back below zero. I'd expect this to continue lower when we update this for today, which overall suggests, again, a bit of internal weakness there. What's the last one I wanted to show you? Here we go. One more chart. Give me a minute. Here we go. There we go. This is the up volume, down volume. So there's a lot of different ways to look at breadth, and I hesitate to go too deep into a lot of different measures, only because I found with something like breadth, if you're not careful, you can find charts to justify whatever you really want to say. If you want things to look more negative, I can find a chart that's going down a lot more. But I think it's interesting to note when we talk about the volume being lighter, if you think about the characteristics of the last couple weeks, since we made that swing high just above 3,200, the market traded off a little bit, gapped down 2 weeks ago, and then has chopped around since there. This is the rate, the cumulative version of volume on up days versus down days. And when it's come down here, sorry, it's volume on up stocks versus down stocks. You can see how this line has gone down, which means when stocks are closing lower on the day, it tends to be on a higher volume than when stocks are closing higher on the day. So it is actually already breaking to new swing lows below the low we had in mid-May, while the S&P is actually holding up. Okay, so price is holding up, but what it shows you is on these big down days, there's a lot of, there's concentrated volume on the sell side. There's distribution, there's profit taking, whatever it is, pushing prices downward. Could jive with what Chris was saying about the reallocation and rebalancing, but certainly suggesting that there's distribution going on. And even though the price has not broken down, the volume picture has gone from neutral to negative to potentially even worse there. So that's our banking on breadth segment today, trying to touch on some of the different breadth measures. And again, very quickly, the breadth picture, in my opinion, has gone from bullish to neutral, and now neutral to negative, where you're seeing some charts like this actually breaking down a little bit, driving home the signals of distribution. We need to wrap up the show, go right to the 3-and-3 charts. 3 minutes. Here we go. Chart number one is looking at, oh boy, hold on a second. I wasn't even ready for it. Chart number one is this one, looking at the percent of advancers and decliners. I think it's just worth noting that almost 90% of stocks were down today on a price basis. And again, one day tells you one thing about the configuration of what we're seeing, and it's a short-term sort of color. Over time, seeing clusters of these up days or down days for me starts to tell me a little bit more about patterns of accumulation and distribution. I'm starting to see clusters of days of about 90%-ish. Down days, I'm not seeing any 90% up days in quite a while. And for me, that tells me we're leaning a little more towards distribution and away from accumulation. This is chart number two. And again, we talked in banking on breadth about some of the different breadth measures. Again, overall, I would characterize in the last couple weeks, things have gone from pretty much all bullish to neutral, and now neutral to bearish. Some things holding up, like the cumulative advanced decline lines, some things turning negative. And I think this volume picture sort of drive some of the volume on stocks closing down on the day, potentially starting to question, the staying power of this market being able to hold its previous gains. Finally, I pointed out just a couple of the bearish divergences we saw in some of the bigger names. Microsoft and Apple come to mind, but it's not localized to that. This is the NASDAQ 100. The Qs look very similar to this, obviously based on this as an index. But the general pattern is a peak the first week in June, a secondary peak now this week, a lot of them yesterday. We can see the distribution again just because of the down move, because of the breadth so negative, very similar to when we established this previous high here the second week in June, suggests to me a bearish divergence of sorts. Higher highs in price, lower peaks in the RSI. In terms of how you would validate that, you look for when the RSI can break below that swing. Look for when the price breaks below that swing low, which means 9,500 on the NASDAQ 100 starts to become a very key level in my opinion. Folks, that's our show for today. Thank you so much for joining us every weekday. Thanks to my guest, Chris Brecher from Brecher Trading. For StockCharts.com and Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.